Hey, Market Chameleons. Thanks for joining us this morning for the Market Chameleon pre-market show. How are you doing, D?
Good, Will. How are you doing?
Great.
Good morning to everybody.
Thanks for joining us. Yep. Before we get started, remember we're streaming on YouTube Live. If for some reason you have a fuzzy picture, that sometimes happens when we use Zoom and live streaming to YouTube, I will send you a link so you couldn't join us on our Zoom chat. Also, ask any questions you want on YouTube Live. If I can't get to them, or Dmitry, a lot of chameleons in the chat will answer them. It's a very active, good community. So with that, D, do you want to start with the disclaimer?
Yeah, let's get that up right now. And so everybody, just keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do or just sharing ideas. If you need professional advice, then go seek out an registered investment advisor or call your broker. They should be able to answer your questions.
Awesome. What are you seeing this morning, Buck?
Okay, let me share my screen. I know you mentioned a couple things that were going on this morning. So this is just as usual, we just start out with the pre-market report, and these are stocks that are actively trading in a pre-market. We have the most active, the largest percentage gainers, largest percentage decliners. You mentioned a couple stocks that were in the news moving, and I'm just gonna go, let me just screen out for higher market cap stocks right now, just to see what's going on in the higher market cap stocks. And I know Tesla's been there in the news. They've announced a 5-for-1 stock split. So here you go, they're up 6.7% in the pre-market hours. I see, let me see, why am I stuck here?
I think Apple went up for days after they announced their split.
Yeah, Apple's been, let me see. Yeah, so here's Apple. Apple's up 1.1% right now. They announced the split. Boeing up 2.1% today. Market obviously up a little bit, 0.8%. Wells Fargo up 2.6%. ExxonMobil 1.5%. Microsoft up 0.7%. So a lot of high cap stocks moving in the morning. I'm going to just go back to the original screen and let's just take a look. As usual, I just take a look at what's moving in the pre-markets, like some of these bigger gainers. So we see CBMG, that's up 35%, but on 45,000 shares. Let's see the next one, EYEG. I think that's like a biotech stock. That's up 31.7% on 1.4 million shares. That's a $19 million market cap. We talk about this, you know, a lot of the smaller market cap stocks will usually see those bigger percentage gainers in the morning. Let's do an analysis. Maybe what we'll do is open up EYEG just to see from a historical perspective, the price action analysis after a large gap move, because we still want to talk about some upcoming earnings. And I wanted to show some new screeners that we haven't talked about before. So I'm going to try to get some of those in today as well, and then answer any questions as we go along. So let's just open up EYEG. So here it is, it's a biotech stock, closed at 410 right now in the pre-market. It's trading $5.40, up 31.7% on 1.4 million shares float. That's compared to its float of 2.7 million shares. This is the range in a pre-market, 493, 791, very volatile. You can see it's a small cap stock. This is how it looked in the morning in a pre-market. That's the pre-market chart. And the biggest VWAP bar I see right now is $5.53, 573, close towards trading right now. This is the catalyst news down here. You guys could go and read it. You know, I'm just looking at it from a price action analysis right now. Let's take a look at historically what the stock tended to do after it had a big gap up in the morning. So this is the gap up history. And let's just take a look here. So this is in the last 3 years, the 12 largest gap moves in the morning. We see these are the dates, any type of press releases that day, any type of catalyst you could read here. So we see here that the average gap move has been 33.8%, which is close to where it is right now. After the opening, the average move from the open to the high of the day has been 9.4%, and the average move from the open to the low has been 17.1%, a little bit biased to the downside. We see from the opening to the close of the day, 92% of the time, it drifted lower for an average loss of 12.9%. Following that news going out 1 day, 2 day, 3 day, that looks like it just weakened, the next day, 2 days out. Average loss 1 day is 4%, 2 days out, negative 5.7%, 67% of the time it declined on both days. So that's a really quick analysis of that EYEG. Again, didn't read the news. If you want to take a look at it, see whatever's different about today's news, then you can make that decision coming out. I'm going to try to maybe, unless there's questions, specific ones in the pre-market report, Will, I'm going to try to go to the earnings.
Go to the earnings, buddy.
All right, let's do that. So these are, and we're winding down with the earnings, but let's see what is coming up in the next 2 weeks, what the markets are predicting the move to be in either direction from an options perspective, and we'll compare that to historical moves. So I'm going to go for options that are traded a little bit more active. So let's just filter out options that on average trade 10,000 contracts per day. So that's the filter up here that I put in. And here we have a list of stocks that are expected to report earnings in the next 2 weeks. And let's take a look here. So just the first one, Lyft, that's today after the market close. Right now, the expected move as of yesterday's close, remember, up or down, this is from a straddle perspective. If you're buying a call, buying a put at the money, is 11.5% in either direction. That compares to a 4-quarter actual average move of 10.2%. So that's taking the absolute average of the moves after earnings in the last 4 quarters, 10.2%. And that compares to a 12-quarter average, last 12 quarters of 10.3%. So a little bit above that 1.3% above the 4-quarter average, 1.2% above that 12-quarter average with a high move of 21.7. Cisco's coming out. That's today after market close. That's expected move of 5.8%. That compares to a 4-quarter average move of 6.4%, 12-quarter average move of 5% with a high move of 8.6% in the last 12 quarters. I think also Baidu, that's coming out tomorrow after the market close. That's expecting, and according to yesterday's close, straddled a 7.2% move in either direction. Compared that to a actual move of 5% in the last 4 quarters and 6.5% in the last four quarters, 5% in the last 12 quarters, 6.5%. So you see that's 2.2% over the 4-quarter average, 0.7% over the 12-quarter average, high move of the last 12 quarters, 16.5%. And really quickly, I'm just going to take a look actually how these straddles performed in the last 4 quarters. So here we have, let's just see here for their full report. I lost my space. So actually what I did want to show after going this, I know that I'm going to go out a little bit further, and I see like Target low is reporting the video. So let's take a look at historically what strategies tended to perform well before earnings from an options perspective, and which ones didn't do so well. So I'm going to go here to our, this is the report where we look at historical option strategies around earnings, and we break it down, doing them different times of day, before earnings, after earnings, opening before earnings, closing before earnings. So you could see here that different types of strategies, opening different times before earnings, closing different times around earnings. And since we saw Target come up, let's take a look at Target. So I'm going to filter out just Target here. So these are all Target, and let's just take a look at historically. So the 25 delta put that in the last 12 quarters, that was a winner. I like to do more defined risk strategies like, vertical spreads or butterflies, iron condos. So we see here the out of the money put spread, selling 25 delta put, buying the 15 delta put, that was a winner in the last 12 quarters, that 12 out of 12 for an average return of 14%. And this is your standard deviation of those was 6%. Let me take a look. What else? Ratio call spread, opening 1 week before, closing 1 day after. That was a winner 83% of the time in the last 12 quarters for an average return of 27%. But standard deviation much higher, 66% on that one. Debit call spread, that's getting long the in the money call, 75 calls, selling the at the money call, the 50 delta call spread. If you do it the day of earnings, so after they reported earnings, the day after to holding it 1 week after, that was winner 83% of the time in the last 12 quarters for an average return of 29%. Standard deviation of that strategy was 28%. Let me see another credit put spread. That's waiting till after the report, so after they reported end of day, selling the 50 delta put, buying the 25 delta put. That was a winner 83% of the time historically in the last 12 quarters. Average return of that was 27% for standard deviation of 26% on the credit put spread after the earnings report. So these are some of the things that tended to work in Target. Of course, you got to take a look at what the situation today is in Target. If there's anything different from history, any type of impact that you think might be different, you got to take that into consideration. So read the news. There's COVID stuff coming out that may be affected. So you still want to take all that stuff into consideration. But these are the things that in the last 12 quarters worked historically. Let's take a look at another one, maybe. Which one else? NVIDIA's coming out?
I think NVIDIA, maybe Cisco, AMAT, maybe.
Okay, so let's take a look at NVIDIA here. I see actually here the credit call spread 3 days before to the day of earning, that tended to work 92% of the time. Selling this is the out of the money call spread, 25 delta call, buying the 15 delta call. That was a winner 92% of the time for an average return of 19%. That standard deviation, 19% standard deviation here. The short strangled, selling the 25 delta call, selling the 25 delta put 3 days before, closing out day after earnings. That was a winner 92% of the time. Average return not so great, 8%, and a 15% standard deviation on that strategy. Let me see here. I was just curious about the iron condor. That's a popular strategy. Iron condor. So you're selling out of money call spread, selling out of the money put spread 1 week before closing it out, right after they report earnings, end of day. That was a winner 83% of the time. Average return was 33%. Standard deviation of that was 64%. Another popular strategy is just selling the at the money straddle. Here, let me just do that. Maybe that would be easier if I just short at the money straddle. So shorting that the money straddle 1 week before closing out day of earnings, that was a winner 83% of the time. Average return there was only 6% with a standard deviation of 23% in that strategy. So really quickly, I just kind of wanted to show where you could get, from a historical perspective, you could start comparing different strategies within the same company, using different open and close dates, and given a comparison, what tended to work best historically. Obviously, you still need to you need to read the news, see what's different, what's going on today. And if there is something going on, then you have to start compensating for that. Will, unless you have.
Yeah, we had a question from Mike around earnings. He's looking to see the actual implied move versus what actually happened. Where do you see that graphically?
Okay, so sure. Did he have a specific stock?
He didn't. I'm assuming you were looking at something and he just wanted to see that stock, but I think you can pick any stock as long as he knows how to navigate around the chameleon.
Yeah. So over here, I just searched for NVIDIA, so it just comes up to NVIDIA's page with all their with all the data in here. So on the side here, earnings, the implied moves versus actual. So that's what I picked here. This has the implied moves and the IV crush under this tab. So here, let's just take a look at what happened in NVIDIA. So this is saying that NVIDIA, the option markets overestimated the move 77% of the time. The average implied move prior to earnings, the anticipated move was on average 7.3%. The average actual move was 6.5%, so about 0.8% differential there. Here are the bars. So these bars up here, that's what NVIDIA was predicting up or down. That's what this bar is. The green is the actual move to the upside, red like this, actual move to the downside. So you see on that day that I have highlighted, actual move was negative 18.8%. That's how much it dropped. The implied move was up or down 9.3%. So much bigger move than anticipated on November 15th, 2018. You see here, if the long straddle, which is a popular strategy, actually a lot of people do the short straddle, but from the long side, that was only a winner 17% of the time. The average return of those straddles was negative 26% from the long side. Long strangle, buying the out of the money put, buying out of money call, that was only a winner 8% of the time in the last 12 quarters, with an average return of those of negative 61%. Credit iron butterfly, that was a winner 55% of the time for an average return of 44%. Credit iron condor, that's selling out of the money call spread, selling out of the money put spread, was a winner 80% of the time for an average return of 35% in NVIDIA. Let's take a look at what the implied volatility did here. So here, this is saying that if we look at the 30-day constant maturity, so an option with 30 trading days to go, not the near term 30 days to go, the average implied volatility crush was 24%. The implied volatility day before earnings, the average was 50. The day after earnings, the average implied volatility was 38.1. 5 days later, the average implied volatility was 37.7. And here's what it looks like today. So here's the average. We see the average implied move day before is 50 with a high of 66 and a low of 40.8. The average day after earnings is 38.1 with a high of 53.6 and a low of 28.4. And this is how it's going out 1 day, 2 day, 5 days out. So that's really quickly where you could go and start looking at actual moves versus the implied moves and the average implied volatility crushes. And this, by the way, we show implied volatility crushes because that's if you're looking to do calendar spreads, time spreads, if you're getting long, 1 month short the other month, the near term month you would use for the move, longer term month you would use for the implied volatility crush. So that's why we have these calendar spreads near and far. That's how you would start, analyzing that from that perspective.
We have a technical question from Dima D. He's asking, when you're talking about butterflies and condors, He's asking what sort of assumptions are being made for the out of the money strike prices. I'm assuming he's thinking of the deltas when you're calculating win rate and return statistics.
So to keep the benchmarks constant for the butterfly, obviously you're using the closest strikes to the at the money and the 25 delta call, 25 delta put. For the iron condor, it's the 20. We're using 25 delta and 15 delta for the credit call spread, 25 delta, 15 delta for the credit put spread. So those are the assumptions that we use in all the tests.
Cool. We had a question relative to Tesla. Someone was asking, looking at, could you go through and talk about the trade cards that are showing up when he brings up the Tesla summary? He was asking about them. Hey, everyone. While Dee's get into that page, remember to subscribe to our YouTube channel. You'll get alerted to any videos Dmitry puts out, and you'll also be alerted to when the pre-market show starts. Give us a nice thumbs up. That's always helpful. And I think Dima's on the trading cards. Are you? Yep.
Cool. So I'm on right now. And so these are trading card, it's defaulted to filter out. So what this is doing is it's going through our different screeners, different spread screeners, using the preset filters that we set, preset conditions that we set. And when those conditions hit, it'll filter out these trade ideas. It's defaulted to the top 3 by percentage edge, but you could go down here, pick, if you're interested in bulk call spread, pick that. Nothing showed up. Let's just do any. So these are all of them right now. And what it's doing is finding, like I said, those that hit the conditions that we set. The trade cards there are starting points for you to get ideas. And what it's doing is looking through different combinations of options and saying, if we ran historical data through them, we compare it to the market price and historically, what would be the theoretical value? So we see here, this is a credit iron condor where you're getting a credit, right? So you're selling at 32.25 based on Tesla's historical moves within that same period. We think the theoretical value is $21.76. That gives you a 15.5% edge. Historically, if you did it at 32.25, it was profitable 70% of the time. That's what this credit iron condor strategy is saying, and these would be the legs that we tested. So selling 12.90 put, buying 11.90 put, selling 14.50 put, buying the 15.50 put. Again, these are starting points, so keep in mind any type of news, anything going on today, you have to take into consideration. So Tesla is in the news. It's been more volatile. They've announced the 5-for-1 stock split. Is this enough, right? Because that could create more movement even, and now you've got things going on there that aren't reflected in the historical data. So you got to look at what's different today, and is this enough edge for me? If not, move on. But these are starting points over here. If you're having just to make things quicker to get trade ideas. Of course, you could go to those same spread screeners. They're all in here. And you could use those filters yourself to filter out ideas and use any filter parameter that fits your risk profile.
Awesome job, D. Listen, I'm going to give a question that Jen asked earlier. She was asking about AMD and what kind of option order flow you're seeing. And she's basically asking around the moving averages. And I know we have a feature. I just thought it would be cool if you showed the people how, when you're on the options chain, you can move around, see where the moving averages are. So if you're looking at option order flow and everything else, you can kind of start to build a thesis about a stock. But it was AMD was the stock she was looking at.
All right, let's just take a look yesterday at how the options, really quick summary of the option order flow. And this breaks down, how many calls traded, how many puts traded. So we see here $110 million worth of notional options traded yesterday. 76 million were in the calls, 34 million were in the puts. 34.7%. So were out of the money calls. So out of the money calls were the most popular out of these group. Then you got 29.3% at the money calls, 22.4%. The next thing, I'm sorry, at the money calls, 29.3%, at the money puts, 22.4%. That just kind of gives you a breakdown by deltas where things are trading. So a lot of out of the money calls here. Let's take a look at the order sentiment. And this breaks down, this takes the, just looks at the buying at single-legged trades in the calls and puts. So it filters out any noisy trade that like spreads, straddles, strangles, just single-legged trades that are regular trades, intermarket sweeps, auto executions, and looks at calls that were on the ask side with the assumption the incoming order was a buy, and looks at the puts on the ask side with the assumption the incoming order was a buy in the puts. So it looks at bullish call buying versus bearish put buy. So we see here yesterday, there was in notional terms, 18.5 million bullish call buying in notional versus 9.4 million bearish put buying in notional. So 66% versus 34%. That 30-day, on a 30-day average, we see it's usually 81% bullish call buying versus 19% bearish put buying. And this is 30-day average, 28.8 million versus 6.7 million. So yesterday, not still leaning towards the bullish side, not as strong as the 30-day average or the 5-day average. 5-day average, $33 million average daily bullish call buying versus 9.7 bearish put buying. So that's really quick from an options order flow perspective.
Very cool. I hope that helps, Jen. She's already said thanks, D.
Okay. Thank you for the question.
We've got about 6 minutes left. No more questions. If you have anything else to show, any dividends coming out today? Any interesting dividends?
Dividends? I mean, you could look at the dividend calendar here, and these are just kind of the dividend calendar for you guys. And one way to also use that dividend calendar, I'm just going to take a look at stocks maybe in the S&P 500. So I'm going to use some of these filters. So these are stocks in S&P 500 coming out today. But if you're trading options and you have like calls that might be a potential exercise, you want to just look a little bit ahead of time. But these are tomorrow's ex-dividend. These are in the S&P 500. So we see Visa coming out tomorrow, Walmart, Eli Lilly, Honeywell, Duke Energy. So these, and you could also do them by your watch list. So if you have a bunch of stocks that you're already trading and you might have option positions on with potential early exercises, you kind of want to get a heads up ahead of time. Because remember, if you have a deep in the money call, and it's only deep in the money calls, guys, it has to be a candidate for an early exercise, and it's behaving already like a stock, that call is not, you're not entitled to the dividend. You would have to exercise that call, convert it to stock, because only shareholders are entitled to dividends. But be careful, it has to be, deep in the money call. You don't want to exercise something that still has premium in it. It's already just, 100 delta call with no premium. So that's really quickly, you could go here, take a look what's coming up as far as ex dividends. Here, let's just take a look what implied vol movers. We could just see here, these are stocks with options that the implied volatility had really high moves yesterday. So we see some of them these are August 14th, but gold, VIX had a really high move, OPK. So you could just take a look here, what has been actively trading, and the options are getting pumped up. Basically, more buyers, than sellers, driving the option premiums higher. And you could quickly, actually, this is really nice because we made it a lot easier for you. We're telling you what the implied move is in that expiration versus a historical stock move given the same days to expiration. So you could see how much over it is, and a historical high move for that period. So if this has 2 days to go, historically, this stock on average moved up or down 4.3% in a 2-day period. And this is what it's implying now. So you got 2.1% over. Made it really easy for you guys over here. It took a lot of work to do this, so enjoy.
That's what the chameleon brings. Well, one last question real quick, D. We have a new user asking about the data. Is it based on the data, the market data?
Okay.
If you want to hit that real quick. He's asking, is it live? Is it based on yesterday's close all day? He wants to know about the data on MarketChameleon.
Yeah, so the market data is on at least 15-minute delay. And keep in mind, we don't control the market data. We license the market data, from the exchanges. The exchanges, actually, they create the regulations requirements. So there are different licenses. The real-time market data has more restrictions and controls that we would have to put in place that actually interferes with our own services, because right now we allow a lot of people, you could have multiple screens for side-by-side comparison, like I'm doing right here. We allow downloads, so we allow a lot of things that we would not be able to do under the controls of a real-time market data service. And also, in a real-time market data service, you have to create contracts with each individual. So you can't just open it up. You have to actually go create a contract with the exchange for each individual. And like I said, we're more of a research tool, research analysis tool, with a lot of historical data and making evaluations based on, price discrepancies, theoretical values, payout diagrams. So right now, that's the idea behind the MarketChameleon.
Great answer. And the MarketChameleon.
We're always looking, though.
Yep,
yeah,
we are.
All
right, the bell's about to go, D. The bell's about to go.
Thank you, everyone, for joining us.
Have a great, safe trading day, everyone.
All right. Have a great day, everyone.
Bye-bye.
Bye-bye.